and welcome everybody. Welcome back to Sectors Made Simple, and today we are continuing our conversation about what in the world is going on in the stock market in April 2025. This is a topic that we've discussed a couple of times in both our free webinars here on YouTube as well as our members webinars for Sectors Made Simple subscribers, but today I wanted to put things in very, very simple terms. Three things that I personally think work pretty well when we're in a bear market or an uncertain market. Hard to really know what we're currently in. And then the other side is three investments that I feel don't work very well in whatever the heck market we're currently in. So without any further ado, let's dive straight into the material for today. Quick disclaimer, today we will be talking about three of the best and worst investments when it comes to a bear market or an uncertain market. Those are my opinions. I encourage you to make your own investment decisions and do your own research. Don't take everything here as investment advice. It is not intended as such. The goal is to share information that I have with you, share my personal opinions, and encourage you to do your own research to make the most informed investment decision possible. Cool. So today's topic, investing in bear market. Whether we want to realize it or accept it, we are currently in a bear market. So we're going to go over three of the best investments and three of the worst investment types whenever we are in a bear market or really any uncertain market. Now, if you're here to just get the answers to those questions and you don't want the whole webinar, I understand that. So instead of teasing all the different topics we're going to get into, I'm going to tell you all of the best and worst investments. And if you want to continue watching this webinar, which I do encourage you to enjoy, I will go into detail about why those are the best and worst options, as well as a few other notable mentions. So the three best, in my opinion, are inverse ETFs, options, and dividend yielding companies. The three worst, buy and hold strategies, mid to long term, short to mid term, my apologies. Technical analysis trading strategies that aren't just day trading strategies. And finally, cryptocurrencies. I know, not stocks, but it is an investment that many people consider, and it is one that I want to include. So those are the three best and the three worst. Inverse ETFs, options, and dividend yield companies are the best. The three worst, mid to short term buy and hold, a lot of technical analysis strategies, and finally, cryptocurrencies. So, we're also going to cover a few others that I feel are worth talking about, not because they are the best or the worst, but because they could be a part of a well-balanced portfolio. So let's dive into it. Hello, Maria. Hello, everyone, by the way. These are recorded live, so thank you all so much for joining us for this webinar live. If you do have any questions about this material, please feel free to put it in the chat. I'm more than happy to answer your questions or have a conversation about what's going on right now. So let's first take tabs of where we are today. The United States is making some interesting decisions, including placing tariffs on all imported countries and most imported goods. There are a lot of reasons that are being told as to why this is happening. There's a lot of reasons that we think this is happening, but the reality of it is these tariffs are pretty crazy. It is a 10% tariff on every country. By the way, this also includes territories that are not populated and a British island territory that is only occupied by British and US military personnel. That's one of the decisions of all time. But 10% tariff on everyone from the penguins to the military to other countries. And for select countries, we have issued higher tariffs. based on the amount of stuff or the amount of tariffs that they charge us. Kind of. That was what was said. It is, here are the tariffs that other countries have on US exports or imports into their country. Our tariffs are reciprocal, meaning we're just doing what they're already doing to us, right? No, that's not what's happening. Because here's the formula that the administration used to calculate their tariffs. It looks pretty fancy, right? It's always a scary time when you're going through learning about math, and all of a sudden, math becomes more letters than it does numbers. This is a lot of letters. And the funny thing is, that's on purpose. The whole point of this is to make it seem like they have a lot of crazy math going on, but let me break it down for you. The E is 4. The squiggly P is 2.5, or sorry, 0.25. 4 times 0.25, 4 quarters is 1. So these two things don't even need to exist. All it is x minus m divided by m. X is exports, m is imports. So basically all they're doing is saying, well, for every $100 worth of stuff we buy from you, you only buy $10 worth of stuff from me. So 100 minus 10 is 90, divided by 90, or divided by 100 is 90%. That is not a tariff. A tariff is saying, hey, if you are importing $100 worth of stuff into the country, then if there's a 10% tariff, it means instead of paying $100, you pay $110. 100 to the company selling you the stuff, and $10 to the US customs. That is a tariff. What this is not a tariff, it is a trade balance. All that means is that another country doesn't buy as much stuff from us as we buy from them. And that's normal. In fact, that's healthy. So their reciprocal tariffs are not based on other countries' tariffs. It's based on trade balance. But getting away from all of that, the reality of it is, it doesn't matter if their math was right or wrong. The end result's the same. 10% tariff on all countries, and higher tariffs for countries that have a larger trade imbalance that they call a tariff. As of yesterday, the average import tariff for goods into the United States was going to be 26%. So if you went to go import something from another country, on average, it's going to cost you 26% more to import that product. Notice, though, this is all past tense. The average import tariff was going to be 26%. Why do I say that? Well, today, Trump announced an additional 50% tariff on China, which brings their tariff rate up to 104%. Now, our largest trade partner is Mexico. Our second largest is Canada. Our third largest is China. So what this is saying is we now charge double. Any goods that come in from China cost double what they would have before. That is a lot. That is a hilariously high tariff to have, and there's no signs that they're backing down. So instead of focusing on the tariffs, let's focus on how the stock market has responded, because we, after all, are looking at this not as economists, but as investors. And of course, as investors, we're going to have a very level-headed, very calm response and an understanding of what's going on, right? Wrong. Market lost its mind. S&P 500 down 19% since February 19th. 12% of that has been in the last week. But from the highest point that the S&P hit, if we look at SPY, for example, it hit 613 and 23 cents, I believe, down to the bottom of where we hit last Friday. That range is 21%, meaning that we, from the top of the market to the bottom of where we've been, was 21%. Anything below 20% is what we consider to be a bear market. So we are now officially in a bear market. But it's not just returns that are a little all over the place. Market volatility has been rapidly increasing. If you want to know which metric we're talking about here, it is the VIX, VIX Volatility Index. It is a 30-day forward-looking indicator of volatility gauged by 30-day expiration options. All of that is a fancy way of saying how freaked out are investors right now about the near term. Pretty freaked out, because this is the third highest that the VIX has been since 1990. The only two times that were higher were 2008 in the Great Recession and 2020 with whatever happened in March of 2020. So we have gone from a market top to a bear market in a little under a month and a half. Realistically, it was even faster than that, because the majority of those losses have happened since April 1st. We are also in the third most volatile period in the stock market since the VIX began. So is everything falling apart? Is there no point in investing right now? Not really. It might seem like there's a lot of stuff going on, like a lot of people are freaking out, but the reality of it is not everything is falling apart. And let me explain. Let's break things down to what we do and don't know about the market right now. Here's what we do know, because that's the easier, longer list. Price changes, which stocks, which companies, which sectors, which industries are going up and down are not random. It might seem like it, especially if you're only looking at it day to day, but over the longer term, not even long term, medium term picture, there are some very, very easy, predictable cycles that we can follow. And I'm going to show you. We're going to look at returns from February 19th to today and use that as a way of understanding if what we know actually is happening. So here's what we know. The market cycle. This idea that during different parts of a bull market and bear market and all of the ups and downs in between, certain market sectors will do better or worse. If everything was falling apart, we would see some sectors doing really well, other sectors doing really badly, and there would be no rhyme or reason to it. Well, here's what it looked like. Now, keep in mind, there are two things I want us to know. One, I do understand that every single one of these is negative. We're not looking at this saying, hey, here's the one sector that's turning a profit right now. Every sector is in the red. But what I do want us to notice is that what sectors are put in what order here does matter, because these sectors from left to right follow the market cycle. So what we find are sensitive sectors on the left being discretionary, so luxury goods, communication services, and technology are the hardest hit sectors. Industrials, materials, and energy not hit as much. But the three sectors that have had the least losses are our defensive sectors: staples, healthcare, and utilities. If we were to believe that we are falling into a bear market, which is the wrong way to say that, we are in a bear market, we would expect a certain group of companies to do, or a certain group of sectors to perform the best. Let me show you. So if we pull up stock charts here and we scroll down, if we were slipping into a bear market, we would expect to see staples, healthcare, and utilities performing the best, whereas the opposite end of the chart is technology, discretionary, communication services. Staples, healthcare, utilities, top performing sectors, relatively speaking. Discretionary, communications, technology, the lowest. So, what we're finding is that sector rotation is still alive and well. It is still following this structure. And in fact, it is almost perfectly following this structure. So, we can say right now, defensive sectors are doing better than sensitive sectors. This is really important because all markets will come to an end. Bull markets cannot avoid bear markets, and bear markets don't last forever. So, if what we think or what we can see is going on is that sector rotation is still working, that means that we can start to track financials, real estate, and then discretionary as the three sectors that we would expect to start to move first. These will be the best performing sectors as we move through that bear market. So, while we can't predict when that's going to happen, what we can predict is which sectors we expect to see that movement begin with first. Financials and real estate, because interest rates are typically something that is pretty flexible during recessions and bear markets. Then, of course, discretionary communication services and technology. The difference between a bouncy ball and a rock. You try and bounce a rock off the ground, not really going to move too much. A bouncy ball, yeah, it's going to spring up a lot faster. Sensitive sectors, they're the bouncy ball. Defensive sectors, they're the rock. So when the market starts to recover, we would expect discretionary and communications and technology, those would be the sectors that see the most gain. Why that matters? Bear markets don't last forever. So understanding where we should be looking for opportunity for recovery is very valuable. And what this shows us is that sector rotation is still alive and well. Continuing on, market cap. Large cap companies right now are performing better than small cap companies. This is something that we would expect to see in a bear market because larger companies can typically deal with that economic pullback, the market pullback better than smaller companies. So, is that happening? Yes, it is. The S&P 500 of the largest companies in the US stock market have a weighted loss of 8%. Mid-cap companies through the S&P 400 have just around a 12% loss, with the S&P 600 small cap index having a loss of 12.5%. Again, they're still all negative. I do understand that. But the point here is not to say, hey, look, here's where we're making a profit. The point is to show that it's not all random. These cycles that we're used to seeing in other bear markets are still happening, which leads us to be able to understand that when this growth returns, when we start to see the market move through that bear market into growth again and work back up to a bull market, the same basic understandings apply. Sensitive sectors, small cap companies will be the first to begin to recover before mid cap and before large cap. So, if what we want to do is track when we are starting to bounce off the bottom and work towards recovery, this tells us that we're not in some crazy, unfamiliar territory. It's a standard bear market. We can look to small cap companies for those first early signs of recovery. Finally, growth versus value companies. Value companies are performing better than growth companies. That, once again, is a basic understanding of a bear market. And is that happening right now? 100% it is. Growth companies on average have a loss of 22%. The S&P 500, just the middle ground, so both value and growth, 19% loss, with value at 15%. What this is showing us, again, the cycles still work. And just like we saw with the market cycle, where we would expect sensitive sectors to show that recovery first, we would expect for small cap companies to show that recovery first. We would expect growth companies to show that recovery first. So, at the end of the day, while all things might seem completely unpredictable and completely random, the basic trends that exist in every single bear market are still predictable and are still working today. So that really should help us to understand that these trends are still working. While the reasons for the bear market might be interesting, the results of it and how it's impacting the stock market is not. So that's the things that we do know. What we don't know is a little bit more interesting, because we need to talk about some things that we can't put a number to or look at a chart and explain. The first is the idea that all of the losses that we expect are priced in. Priced in is an interesting term. Interesting seems to be the theme of today. Priced in basically means that investors are trying to predict what they think will happen and are buying and selling based on those feelings. So they already have an idea in their head of how bad tariffs are going to be, and they've priced the stocks accordingly. It's impossible for us to know how much of that 19% loss is actually real versus how much of it is just what the market thinks is going to happen. So if the value is priced in, if all of that panic, if all of those tariffs are already included in the stock price, what that means is that any good news, or honestly any lack of bad news, is going to cause the stock market to surge back up. I've read a lot of conversation of investors panicking because they think there's no catalyst. This idea that we need something to push the market back towards a bull market. Personally, I don't think we need a catalyst, because the catalyst is just no more bad news. If we are to think that the market is already priced in all of the tariffs and even potential tariffs that are escalated, then anything that comes out that's not worse than that is going to be good news. And if we look at what happened today in the stock market, it does defend that point. Overnight, China said that they have no intentions of backing down on tariffs. despite the US threatening to add another 50% tariff on top. Stock market opened over 2.5% up. Why? There's no good news. There's only more bad news. But that was a potential sign that the market had already priced in panic and further escalation of trade wars. So the minute we saw that China was going to have a more level-headed response to things, the market celebrated that for all of 3 hours until Trump said that he does intend on adding a 50% tariff to China, and then the market declined once again. But the reason that that's important is that we don't know that just because the market went down yesterday, and the reason that it went down is still there, it won't go up today. These ups and downs can be seemingly random on a day-by-day basis. The other thing that we don't know is what's going to happen next with tariffs. The problem with tariffs, or at least the way that they're being used, is there's no sort of lead time. If you were investing in the market yesterday, there was a massive surge in the morning because all of a sudden we thought that there was going to be a 90-day pause on tariffs to allow time for negotiation. Well, that turned out to be a bold-faced lie. There wasn't any discussion of pause, and it caused a $5.5 trillion swing in the market in about a half hour. All of these tariffs are being enacted and are beginning 2 days after they're announced. The tariffs announced on April 2nd began on April 4th. The tariffs announced today on China are being implemented tomorrow. So we don't know what's going to happen with tariffs. We don't know what additional tariffs there will be, if other countries will back down on tariffs. And the reality is Trump does not seem keen on dropping these tariffs whatsoever. He calls them medicine. We are sick patients, and tariffs are our medicine. We don't want to take the medicine, but we'll feel better after we take it. Whether you agree with that or not is not really a discussion for this webinar. But that is the moral of these tariffs in his eyes, is short-term pain for long-term gain. But unfortunately, the long-term gain part is a huge unknown. Right now, the plan seems to be tariff, cause disruptions in supply chains, and screw the consequences short term, and eventually things will work themselves out long term. Let's go short term though, because that's what actually matters, and that's how we live life day to day. We have no idea how these tariffs will affect unemployment, inflation, and the big recession word. This was something that we thought was a far out idea a couple months ago. And in the past 2 weeks, large institutions such as Goldman Sachs have increased their likelihood of a recession this year from 15% up to 40%. So a higher likelihood of us having a tariff is growing by the day. And we don't know what might come next with tariffs. So what we do know are that these large trends in the market still work and are still there. What we don't know, though, is what's going to happen short term and how much of the panic is actual panic versus how much of it is the market pricing in all of these tariffs ahead of time. I'm just going to be honest. All of the craziness over the past week or so has been really stressful as an investor that really tries to look more at the mid to long term side of things. And I read a really interesting article on Investors Business Daily where it was an interview that one of the people talking said this: "We can't control how tariffs affect us, but we can control how they affect our investments." And that's really true. We have no control over what tariffs will be implemented, on what countries, with what percentages. But what we can do is have control over where we are investing our money, short term and long term. Which leads us to why I wanted to do this webinar. I wanted to look at this webinar to be able to go through different types of investments that I feel work better or worse during times like this. So, before we get into the 3 best and the 3 worst, I have a couple of honorable mentions. Chris in the chat is saying, quiero aprender cómo invertir en opciones. Si quieres aprender sobre opciones, ahora tenemos una serie de webinarios con mi madre, Julie. Ella ha hecho una serie que se llama La magia de las opciones. Estoy buscando para el enlace para ti. Esta serie va a incluir enseñas para al principio de cómo puedes abrir una cuenta para invertir en opciones, las maneras y estrategias para invertir en opciones y ejemplos de sesiones en vivo a invertir en opciones también. Thank you, Magnolia. Si entras a este sitio, puedes ver el curso allí. Y si tienes interés en una suscripción de Sectors Made Simple, si tienes una suscripción anual para Sectors Made Simple, esta suscripción incluye acceso a las clases de la magia de las opciones. Sí, claro. Really quick, gonna translate that. We do a lot of bilingual education here. Our goal is to be able to offer education for investors in both English and Spanish. So Chris was asking about if we have education on options, primarily in Spanish. So I wanted to share the link with him. So diving back in here, there are the 3 best and worst investments, but a couple of other notable mentions that I want to include. These are not the best or worst, but they are valuable for us to talk about. The first one, long-term buy and holds. This idea that you buy something and you hold it for months, not just months, years. That still works. The reason that I think that still works is all of those trends, those macro market trends still exist. Sector rotation's alive and well. We expect for growth companies to be underperforming compared to value companies in a bear market. All of the basic principles of what makes a bear market and how we move into and out of a bear market still seem to be solid. So, if you're buying something long-term in something like a 401k, and by that I mean your S&P 500s, your target date funds, anything like that, even a growth ETF, those are still going to be valuable long-term, in my opinion. There is nothing to say that growth companies are suddenly going to start dropping like flies. So long-term buy and holds, in my opinion, still work. The reality is, there has never been a bear market that we haven't recovered from, even the Great Depression. The stock market has always recovered from from any bear market, from any recession. And do keep in mind, this is looking at the S&P 500, the Dow Jones, our large indexes. There will always be companies that go out of business and go bankrupt whenever one of these recessions or bear markets happen. That's the sad reality of it. But if we're just talking about the market or a broad index or a fund that tries to invest more long term, there's no reason why those will start to suddenly collapse, in my opinion, during a bear market. Then there is the tried and true old school defensive investment, gold. In my opinion, still works. The only reason why I think gold is a little bit risky right now is because so many people had the same idea. Everyone started to look over at Warren Buffett and saw him pulling cash out of the stock market and either holding cash or putting it in safe investments. So a lot of people started to dump their money in gold. Anytime people start to flock to an investment, if the supply doesn't change, but the demand goes up, the price will come down. But with that said, gold is still up 0.5% today, down only 4.5% in the past 5 days. Keep in mind how bad the S&P 500 has done over that period of time. Up 3.4% in the past month, 13.6% in the past 6 months. So gold, it's still gold. It will always be gold. Bonds and treasury notes. These still work. Fixed income securities still work. The only risk that I see there is the fact that right now, their yields are not that great. They're somewhere in the range of 4.2%, if I recall. If inflation starts to rise and goes above 4.2%, sure, you're not losing money with these treasury yields, but you're also not really making money. So it is a little sensitive to inflation. Now, for the very astute, you might be thinking, well, there are tips. These are inflation protected securities. And yes, those are there. They're still valuable, but they do come with their own risks. I've done an entire webinar on tips in the past. But overall, bonds, treasury notes, treasury securities, all still work. This one's a fun one. Buy the dip. How many times have you heard an investor say, just buy the dip? It's the very easy kind of like, well, duh, why didn't I think of that way of investing? But it's kind of true. There's this idea called DCA, or dollar cost average. Buying the dip doesn't have to just mean, in my opinion, that you wait until the market hits the absolute bottom and then you buy right now. Because here's the problem. How do you know where the bottom is? How do you know that where we are today in the stock market is the bottom and right now is the time to buy? You don't. Again, going back to what we don't know how much is priced in. We don't know if this is the bottom. We don't know if we're about to drop more. We have no clue. The average bear market goes past 20%. It's an average of 32% loss in the S&P 500 for a bear market. So we don't know if it's going to be 20% or 40%. I hope it's not 40. But buying the dip is an easier idea than you might think. So DCA, or dollar cost average, is a way of thinking about buying the dip without just waiting for the bottom. Instead, it's the idea of when it goes down a certain amount, you can buy some. Say you bought a share for $10. Then it goes down more, you bought a share for $8. Then it goes down more and you bought a share for $6. Your average, you bought 3 shares and it cost you $10, $8, $6. Basic math, $24. So your average that you paid per share was $8. The advantage there is if it bottomed out at $8, great. You bought one at 10 and one at 8, your average is 9. If it bottomed out at 6, then you bought 3 with an average of 8. By constantly thinking about buying a little bit as it goes down, yes, you have short-term losses, but it still allows you to have a lower average price per share. So when the price does begin to go back up, you think or you have the better feeling that you did buy the dip. So does it work? Yes. Can it be very tricky to do? Also, yes. You need to find the right company. You need to find when you want to buy. You need to find how much you buy. How much do you think it's going to still go down? There's a lot that goes into that. The other one we've already talked about, macroeconomic trends. Big, ugly words that I had to learn in college to basically say it's the way that the market goes up and down and the economy goes up and down. It still works. We saw that through 3 different charts before, but it's not very predictable short term. It is really hard for us to know what sector or what area of the market is going to go up today or tomorrow. What could be going up today could be going down tomorrow and vice versa. But these last two, buying the dip and macroeconomic trends, those are things that we can help with. We have created a lot of different investment tools here at Sectors Made Simple, and some of those tools include the ability to find what sectors are leading the market. So for example, I could look and say right now that compared to 3 months ago, well, first off, our current sector leaders would be XLP, S&P 500 staples, utilities, and healthcare. Well, staples, utilities, and healthcare, top performing sectors overall. Worst sectors, materials, technology, real estate, energy, discretionary, a little bit of a mix of things. Which, if we look at the returns, again, this is since February, over the past 2 months. Yeah, those are all doing somewhat poorly, but what this is telling us is more short term, which ones have been performing the best and worst. This data is updated every day and is based on today's picture, not by the overall returns. For all we know, discretionary could have dropped 22% on February 20th and has done nothing since. So we can use these 2 different tools to see how these sectors are moving. Just like we can see which sectors are gaining and losing strength, short term and overall. Overall, once again, staples, healthcare, utilities, technology, energy, financials, discretionary, communications. So, sector rotation still is there and is a way that we can look at those macroeconomic trends. And why does that matter? Well, we want to know when this starts to move, not by looking in the past, not looking at 2 months of total returns to figure out what's happening. I want to have a more actionable, more updated picture of where we are at. It's the same idea of using an exponential moving average instead of a simple moving average. I want to know what's moving and what's changing today. And that's what this does for us. It's telling us what is moving and how quickly. Where if we look at what's changed from yesterday, almost every single sector has had a massive swing in short-term strength. That's not normal. That is hilariously not normal. So what this means to me, you might look at green and say that's a good thing. I look at this and say, not a good thing. Because what this is telling us is that all of these different sectors are gaining strength, but that strength is kind of meaningless right now because things are changing so quickly. So what we can do is wait for leadership to really be established. wait for some sectors to have high counts like 19 and 18, while others are more in the 3, 2, and even sometimes 0 range. That is a more normal matrix. The other thing we can do is look at what sectors have the most companies in sell signals. The reason that we want to do this is that it is a contrarian indicator. This idea that we wait to see when everyone is selling, because now we see where the opportunities are. If we know that 92% of, or if we know that only 8% of companies in the industrial industry or sector rather are on buy signals, when that number starts to go up, there is so much more room for it to grow. So we have multiple different ways of looking at sector rotation, that market cycle, to find when that movement begins. Because I don't want to wait to see that 2 months ago, all of a sudden real estate started to take off. I want to know the day it happens or the week it happens. And that's where tools like the matrix can come in. The other side of it are companies. Finding leading companies in the S&P 500 are extremely easy when we have the ability to rank all of the companies in the S&P based on their strengths. So we can find which companies have the highest strengths, which ones have the lowest strengths, and which ones are changing, which ones are changing short-term and long-term as well. These tools do take a little bit of time to learn, but once again, that's where all of our webinars come in handy. I've covered many different ways of using these tools for anything from short-term to long-term investing. So, if you're interested to learn more about those, please shoot us a quick email. I'm going to jump to this end slide really quick and then we'll get back to the fun stuff. If you do want to learn more about those tools or the education we offer here, or how we can help you out with your investment goals, please feel free to reach out to us. It is a pleasure to be able to help you on your investment journey, whether you decide to purchase our tools and education or not. You can schedule a one-on-one with me if you want to discuss your goals personally, or if you don't feel like talking with me face-to-face, totally fine. You can send me an email at support@sectorsmadesimple. I just posted the link to our one-on-one scheduler, so if you wanted to schedule a session with me, it is totally free. You don't need an account. You don't need to put in a credit card. You can sign up there. But let's get back on track here and let's dive into our 3 best and worst strategies. Starting off, one of the worst is a buy and hold. This is the old school approach of buy low, sell high. And right now, we don't know where the bottom is. While dollar cost averaging can help, the reality of it is even the best of the best are still losing value. So if we are trying to actively trade stocks, buy and hold is not going to be it. So we can still look for things with a more long-term picture. But if I were buying something for a week, hoping that it goes up in price, probably not good odds. The reality of it is, like we saw before, even the best sectors are still posting heavy losses. So over the next week, it is almost impossible to say what will go up or if it will even go up. So short-term buy and hold is probably one of the worst. But there is an alternative. If you want to buy something short-term because you think the market is going to move in a certain direction, there are inverse ETFs. Inverse ETFs, or exchange-traded funds, are funds that allow us to invest into a certain index, like the S&P 500 or the NASDAQ 100. But these funds are inverted. So we profit. The value of this fund goes up if that index goes down. This allows us to profit when the stock market or a particular index is going down, without the need to get involved in options, which require special permissions, or shorting, which is a whole other world of things to consider. So, this is a great way if you want to bet that the market is going to go down and you didn't know that you can actually buy something that profits if that happens. Some funds can even offer leverage. For example, 2x. With a 2x inverse fund, if the S&P 500 goes down by 1%, this fund on average will go up by 2%. But the S&P 500 goes up by 1%, this fund would go down by 2%. So really, this is a great investment to consider, but is not a foolproof strategy. Because, like I mentioned before, bear markets are temporary. Markets and indices have always recovered their losses over time. So, by investing in an inverse ETF long term, the house is probably going to win. So, investing in one short term can be a great opportunity. Investing in one more long term, you're starting to play with a little bit more risk of that long term uptrend. Now, getting into the second of the three worst investments, technical analysis trading. This one hurts me because it is very fun and very interesting. But if we're just talking about midterm investing or swing trading or point and figure breakouts, anything like that, yeah, that's probably going to be one of the worst right now, in my opinion, because we don't know how much of the fear in the market is priced in. We don't know if the S&P 500 is already considering a 35% tariff. We don't know if they're considering a 20% tariff or if they think Trump's going to remove tariffs tomorrow. So if we see a company go up today, there's no guarantee it will go up tomorrow. Just because we saw something go down today doesn't mean it can't go up tomorrow, even if there's no new news. Again, this morning, despite 50% tariffs on China, the S&P 500 opened up 2.5%. So the uncertainty and the randomness in the market make it extremely difficult to believe any technical buy signal. If you are buying with 1-day bars, those, in my opinion, are incredibly unreliable right now. The reasons that a company is going on a buy signal could be so random and so difficult to understand. There's only one specific example that I think technical analysis can work very well. And I kind of hinted at it because I said, if you're using daily bars where every candle or every piece of information is 1 day's worth of price. Option. High volatility, which we have right now, can be a world of opportunity for options traders. Because if you're investing very short term using something like 5-minute or 15-minute bars, that means that the amount of price change within those 5 minutes is crazy. So you can find entire entries and exits in the course of a half hour. Plus, you can invest getting positive returns you can generate profits off of positive and negative returns in the underlying investment. If you buy puts, you are making profit if the price goes down. If you are buying calls, you're making profit if the price is going up. An option trader doesn't care if the market's going up or down, they just don't want it to go sideways. And let me tell you, the market is doing anything but going sideways right now. So options traders are having a field day. While options are a very high risk, high reward opportunity, they do allow investors to do something I personally think is very important in a market this unpredictable: holding cash. If we see that everything over time is going down, cash is, well, it's cash. You don't need to worry if your cash is going to open in the stock market tomorrow and go down. It's cash. But you're not just sitting on that cash in a savings account. You're still actively investing with that money. But if you're just day trading options, you know that you can cash out. And at the end of the day, you are holding cash. You can go to sleep, wake up and not have to worry what the market's doing, and go back and start trading options once again. So while options are high risk and are high reward, the ability to invest in the market and hold cash outside of the limited time that you're actually holding an option is a very lucrative and very reassuring position for many investors. Which brings us to the last pairing. Now, not really a pairing because these are somewhat different, but the third worst investment, in my opinion, is crypto. Now, I know I'm probably going to lose some people or anger some people by saying crypto is, in my opinion, a bad investment for a bear market. Hear me out. Some investors view crypto as a safe investment if the stock market goes down. Their idea is that traditional currencies, traditional markets thrive when cryptocurrency isn't really doing much. But when the market starts to decline, that's where deregulated or decentralized investments like gold or like crypto could perform well. So many people consider crypto to be the digital gold. This might have been true in the past, but it isn't really true today. There have been a number of different studies that look at how major coins, now I'm not talking whatever tiny altcoin you're looking at, those different world entirely. I'm mostly looking here at things like Bitcoin and Ethereum, established, used blockchains that have strong, reputable value. There have been many studies to show that there is a positive correlation between these coins and the S&P 500, meaning that when the market goes up, these coins also go up. If the market goes down, these coins also go down. Smaller coins, altcoins, no correlation. That doesn't mean that they are opposite. That doesn't mean that when the market goes down, they go up. Instead, they just have a mind of their own. The other thing is that crypto is a fairly unregulated market. There is no New York Stock Exchange for crypto. There is crypto exchanges like Binance and Coinbase and whatnot, but there isn't the same amount of oversight and legislation and history that the stock market has. And the crypto market never opens or closes. It's constantly trading. So altcoins, the reality of it is those are oftentimes scams. Those altcoins can promise some hilariously high returns and end up rug pulling everyone or just having the value deteriorate to nothing. If a stock loses value, there is still a company behind that stock. If a cryptocurrency loses value, there's nothing there. The value is simply what someone else is willing to pay for it. Now, I want to circle back. I want to make sure that we understand. I do not personally think crypto is a bad investment overall. The only reason that I say it is a bad investment in this context is because I personally feel that if you are looking at crypto as the as the inverse of the stock market, like you're looking at gold, it's not that. Crypto is a valuable investment for people to consider if that's what they want to do. But if what you're looking for is a way of hedging against the market, crypto ain't that. So, and also crypto is becoming less and less regulated. Not really as important though. So wrapping things up, the third best investment strategy or investment type, in my opinion, are dividend yielding companies. Dividends offer a way to generate returns regardless of what a stock's price is doing. So if the stock goes down or if the stock goes up, it still is going to have the dividends being paid out. There are lists such as the dividend kings and the dividend aristocrats, which are lists of companies with 25 years or more of consistent increasing dividend yields, meaning that they are continually paying out dividends regardless of what's happened. 50 years is a lot of time. That is a lot of bull markets. That is a lot of bear markets. That is recessions and expansions and everything in between. And they've still been around and they've still offered increasing dividend payments every single time. Plus, if you choose to reinvest your dividends into more shares of the company, a lower share price means more equity. You get to buy more shares of that company with that dividend payment. DCA, dollar cost averaging, it kind of plays itself. Meaning that when those shares start to go back up in value, hopefully they, again, never guarantee, but the hope is that they go back up in value. You now own more shares for that value to grow with. All right, that was a lot. The goal of this webinar, after everything's said and done, is not to make you freak out or think that now is the worst time to be an investor. Right now is the best time to learn how to be an investor, because a bear market ends and a bull market begins. But understanding when that bull market is beginning, what the signs are of a bull market beginning, and the ways that we can capitalize on it are incredibly challenging unless you know where to look. And that's where we want to come in. Our tools help you to understand and study the market more and find opportunities in bull markets and bear markets and everything in between. And our education is here to help you keep a finger on the pulse of what's going on in the stock market and to talk about current events and ways that we can invest in whatever's going on in whatever kind of market. Again, we cannot control what is happening with tariffs or what's happening with the economy. We can control what we do with our money and our investments. And I hope that what I've done here today is show you that even though there's a lot of uncertainty, there is so much that is still certain and is still predictable within the stock market that we can grab onto and understand that this is just another bear market, and how bear markets have been in the past has not changed. So, if you have any questions or want to chat more with me, you can send me an email at support@sectorsmadesimple.com or schedule a one-on-one with me via the link that I posted in the chat. If you're watching this recorded, it will be down in the resources section in the description. Thank you all so much for joining us. We hope to see you all back very, very soon. Take care.